Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. Over the many decades that I've been an investment advisor and in the investment business, I've had to listen to the arguments about the validity of strategies like buy and hold investing versus more active investing, and then of course that leads into active investing or building your own portfolios versus passive investing or investing in an index. And I really always find those arguments kind of silly because to me, investing is always about prudence, and being a prudent investor means paying attention to things like valuation and the potential growth. So I'm going to start this particular video, which goes with the article, the written portion of the article, and talk about index investing first. I'm not necessarily against investing in indices, although I personally don't do it. I like to build my own portfolios. But if you would rather let someone else do it for you, then, buying an index does allow you to participate in the long-term growth of the quote-unquote market and or the economy, depending on what index you use. I'm going to use the S&P 500 here for purposes of this video, and I want to make a point. Back in calendar year 2000, going all the way through 2009, this period here, which I pointed out in the article, which ended here at the end of 2009, if I can hit it correctly here, this actually is what is referred to, or was commonly referred to as the lost decade. And this was obviously mentioned numerous times to say where buy and hold investing was, a bad strategy. And you could also use it, or I did, to make the argument that index investing was not always the smart way to invest. The answer is it really depends. So obviously what was going on here, if you look at the S&P 500, the multiple was over 28 on December 31st, 1999. That's an extremely high valuation for the market, significantly higher than historical norms prior to, which I'm not showing on this graph, and subsequent to, what I am showing on this graph. And the point is that's kind of a ridiculous valuation for the market. The earnings yield there is minuscule. Obviously, we had a clear period of overvaluation, and we actually went through two recessions during this decade. The recession of 2001, and then, of course, what I refer to as the Great Recession of 2008 and the spring of 2009. And had you bought an index fund over that time frame, you'd have actually had a negative rate of return. You would have had a 24% negative growth. You would have received a little bit of dividends, but you would have ended up turning $10,000 into $8,999, or a total rate of return of a negative 10% or 1.1%, negative 1.1% annualized rate of return. Or so in other words, you lost money over a decade, both in terms of capital and got minuscule income as a result. So that clearly invalidates buy and hold, but it also invalidates what I would call index investing or passive investing. On the other hand, I'm going to pick a little better time frame than I used in the actual article. Had you bought the S&P, let's say in June of 2010, when it was trading at a discount to its normal PE, a slight discount to its, I'll call it fair value PE of 15, or its more normal PE of 18, and held it through yesterday's close, the market would have generated a rate of return for you of over 14.4% annualized, turning $10,000 into $36,617, or almost, quadrupling your money over that time frame. So this, to say is index investing or is passive investing right or wrong, or is buy and hold investing right or wrong, is kind of silly. As I pointed out in the article, it all depends. And you can carry this notion further. When you're looking at, say, a growth stock, a dividend growth stock like Apple, well, I'm going to shorten this time frame because Apple had a tremendous growth rate from 2010 through recently. It averaged over 25% growth. But I want you to notice its normal PE was about 15. It's trading at a much higher valuation than that now because what's happening, this 25% growth is slowing down. As I shorten the time frame, you see that Apple's growth has only been about 10.75% growth since 2012, and this has a fiscal year of September, by the way. It's not calendar years. And the point is, I think Apple's overvalued currently, and I actually still have a large position. I'm watching it closely to be careful that I don't let all of this, what I call false profits, where the valuation has gotten ahead of myself, go away. But I'm not ready to throw the stock away yet either because it does have plenty of momentum. But I'm at least aware of the fact that the stock is no longer inexpensive. Now, the rate of return over this time frame has beaten the market handily. And if I go back to that 13-year time frame, which I originally started with, it was even significantly better. We ended up with a 27.7% annualized rate of return versus 12.9 for the S&P over that time frame. So, the reality is if you buy the right company at the right valuation, buy and hold is a tremendous strategy, even going through all these ups and downs. Now, here's a case where you have the Ascena Retail Group, where you have a totally different picture here. And again, I'm going to shorten the time frame, which I showed in the article. You would have lost a significant amount of money. Your negative rate of return annualized was 26%. You'd have turned $10,000 into $390. And the company paid no dividends. And the point is, this is clearly not a buy and hold investment, because what was happening here, your fundamentals were deteriorating year after year after year. So maybe, you could have saw a weakness in earnings and been smart had you bought it here and made this profit. You could have saved yourself and got out here, and you could have gone another year. Now you've got 2 full years of negative earnings growth, -7 and -20. You would have still saved yourself from money if you'd have been smart enough at this point to come out. In fact, I can calculate the performance for you there. From here to here, you'd have averaged 11% a year, which isn't too bad. But as the fundamentals continued to deteriorate, obviously from here to here would have been a horrible investment. Again, losing over 26% of annualized negative rate of return over this time frame. This is not clearly what you would want to do in a buy and hold. And similarly, if you do look at a dividend paying stock like CenturyLink here, and I look at this 13-year time frame, this isn't a buy and hold stock either. Now, this stock is very alluring because it currently offers a high dividend, and it does trade at a very low valuation now. So if you bought CenturyLink today, you may or may not be making a good investment. That's going to still depend, because its earnings growth is expected to be very weak. But the point I want to make is if you'd have bought it here and held it through here, you'd have actually had a negative rate of return over that time frame. And I want you to notice this white line is the dividend. There were times when they were paying out over 100% of their profits, which is the green shaded area, in dividends, which obviously led to a dividend cut. And then they recently cut their dividend again in 2019 from $2.16 in 2018 to $1. Once again, clearly not a great idea to buy and hold a stock like this. And similarly, you had a similar situation with General Electric, which was a very widely held and highly regarded stock, especially during the Jack Welch era, where he was turning the company from a appliance manufacturer into a finance company. And there were a time when the valuation got ridiculous. This was also a double story here. This was like the index. You were paying a ridiculous multiple to buy General Electric. And even if you held it while it was still doing well as a business, where the business was still growing, notice the orange line, earnings growth here was 19, 11, 7, 3, 8, 16, 11. This was all positive earnings growth. You would have still lost, almost 40% of your money holding the stock because valuations was so high. So valuation was horrible then. But then you went into, when the financial debacle hit, the company's earnings collapsed, and so did their dividend. And then even following that, they're still having trouble getting their act together. So, the long-term buy and hold of General Electric over this time frame would have been an abysmal investment, losing almost 75% of your money. Even when you count dividends, you still had a negative 3% annualized rate of return holding General Electric over this time frame. Now, in contrast, if you bought something like a Ross Stores, which had an impeccable record of growth historically, and even though your multiples here are a little higher than typical, anytime you'd have bought this stock when it was reasonably valued, and as I did in the article, I measure it to fair value, you still would have ended up averaging over 17% a year. However, if you would have, held it through today where the valuation is extremely high, you can see that your rate of return is even better at over 22% a year. So the point is, buy and hold, index investing, passive investing, etc., everything only makes sense in the investment industry when it's done intelligently and when it's done prudently. Now, I don't favor active trading. That's what I really call speculating. I do favor being a long-term investor, whether you choose to invest in an index or you choose to invest in a stock. But try to make sure if you're doing an index that you're buying it when the valuations make sense and the economy looks good and there's potential. Don't just blindly buy an index fund because someone said that's what you should do. And the same with individual stocks. Do your due diligence and do your homework and try to make good long-term sound decisions, and always consider valuation and growth potential potential, and then constantly monitor. Be constantly watching your investments to make sure that the original thesis that you identified remains intact. Anyway, this has been Chuck Carnevale saying thanks for watching. Look forward to talking to you soon. And if you like what you see here, you might want to consider taking a look at our marketplace service, the Dividend Kings, here on Seeking Alpha. Thanks.